This not the same way. It could be a failure of a margin call. It's possible. I mean, if you were suddenly short 113% of GameStop's float at, a loss of 2,700%, that that's like that would be really bad for your fucking margin, right? I mean, you clear it up real quick, but yeah, SoFi is probably pretty low. Is it still under 20? That's a okay entry. If you want to go long on it, I wouldn't try to play SoFi on the short term. I think they have a good future. It's possible, yeah, Dolly Dillerson. Generally, if multiple positions find themselves short on something, they will have one of those positions manage it. So one person will manage the whole position, and what that does is it keeps them from fucking each other, right? So someone can't go, "Oh, I'm going to bail first." Then one entity is controlling the position, and that creates stability and trust, and that they know that the other guy isn't going to fuck them, kind of like a drug deal. Bought a 1 Feb 200C yesterday for 23.50 to avoid any volatility at earnings. Plan on averaging down after earnings if we drop. If not, gonna go with a couple 250s. Gonna get my 100 shares. Congratulations, Papa Muff. Best of luck to you, man. Have you any theories on how they were able to short GME so hard that they hadn't done the necessary GEX buying in order to stabilize their margin? Oh, I do. Yeah. I think Melvin was short GameStop. I think they were predatorily shorting the stock into the ground. That was their goal. They had a strong bull case. It's not like they were wrong. Like when they started shorting GameStop in 2014, it was a pile of shit. They to be short on it was a great idea. And they shorted it down and down and down and down, and they kept compounding their short position, probably using synthetics were available. But then in March of 2020, bigger players, much bigger players, Melvin's small fund, decided that they were going to short fucking everything, all retail, every fucking store in a mall that you can throw a rock at, every strip mall, every retailer in America. E-commerce was skyrocketing, and what they did was synthetically by shorting those ETFs, massively compounded the position of the shorts on GME. Un, un, Unknowing of the counter position, right? They could have known that that other position was there. They were just shorting everything, and where GameStop is unique is in its exposure to ETFs. GameStop is in a shitload of ETFs, not just retail, right? Because it's got this software tech side, it's got this e-commerce side of it, and so it's much more diversified across ETFs than a lot of these other meme stocks are. And because it's in so many ETFs, and they shorted all the fucking ETFs, when January rolled around, they both realized they were very, very short GameStop after Ryan Cohen's buy-in locked up some of the float. I think they may have started to realize this back when GameStop initiated its share buyback per Burry in 2019. And basically what this meant is that both entities together were massively short GameStop, far more than they had expected. And we saw that realization kind of peak when they turned off the buy button and funded Melvin's margin, right? A $2 billion investment into Melvin's margin, margined is, 1 to 5, 1 to 10, 1 to, something around there. So you're talking about a 10 or a $20 billion marginable cash investment. And that prevented the margin call on Melvin that at that time would have destroyed this much larger ETF short position. So yeah.